Okay, we're recording.
Okay.
We're now recording.
All right. As a preliminary matter, this is Joseph Scare, the Chairman of the Board of Trustees of the Town of Needham. Permit me to confirm that all members and persons anticipated on the agenda are present and can hear me. Members, when I call your name, please respond in the affirmative. State each member's name. Okay. Hayden.
Here. Hayden Traub.
Dan.
Dan Burns, and I'm here and I can hear you.
Evie.
Evelyn Finesse, I'm here.
Barbara.
Barbara Howard with Rockland Trust, I am present.
And Brian.
Hello, Brian Callow, Rockland Trust, Investment Management Group. Good day, everyone.
Okay. All right. Good afternoon. This open meeting of the Board of Trustees of the Commission of Trust Funds is being conducted remotely, consistent with Governor Baker's executive order of March 12, 2020, due to the current state of emergency in the Commonwealth due to the outbreak of COVID-19 virus. In order to mitigate the transmission of COVID-19 virus, we have been advised and directed by the Commonwealth to suspend public gatherings, and as such, the governor's order suspends the requirement of the open meeting law to have all meetings in a publicly accessible physical location. Further, all members of public bodies are allowed and encouraged to participate remotely. The order allows public bodies to meet entirely remotely so long as reasonable public access is afforded so that the public can follow along with the deliberations of the meeting. The public is encouraged to follow along using the posted agenda unless the chair notes otherwise. Ensuring public access does not ensure public participation unless such participation is required by law. This meeting will not feature public comment. For this meeting, the Commission of Trust Funds is convening by Zoom app as posted on the town website, identifying how the public may join. Please note that the meeting is being recorded and that some attendees are participating by video conference. Accordingly, please be aware that other folks may be able to see you and that take care not to screen share your computer. Anything that you broadcast may be captured by the recording. Meeting business ground rules. We are now turning to the first item on the agenda. Before we do so, permit me to cover some ground rules for effective and clear conduct of our business and to ensure accurate meeting minutes. I will introduce each speaker on the agenda. After they conclude their remarks, the chair will go down the line of members, inviting each by name to provide any comment, question, or motions. Please hold until your name is called further. Please remember to mute your phone or computer when you are not speaking. Please remember to speak clearly in a way that helps generate accurate meetings. For any response, please wait until the chair yields the floor to you and state your name before speaking. Finally, each vote taken in the meeting will be conducted by roll call vote. Okay, we're going to start off by, I am asking for someone to approve the minutes of the past meeting of September
16.
16th.
I make a motion to approve.
Dan?
And I second that motion.
Okay, Dan seconds the motion. All in favor, say aye. Hayden?
You have to roll call, Joe.
Aye. Oh, roll call.
Dan?
All right. Hayden proposed the approval, and this is Hayden. I vote aye. Yes.
Dan?
Dan Burns, I vote aye.
This is Joseph Scalia. I vote aye. The meeting, the minutes have been approved as read. Now I'd like to turn to our guests and have them review the portfolio for the past year. Barbara, do you want to start that off?
I will. Thank you very much. This is Barbara Howard with Rockland Trust Company, the relationship manager on your investment account. So I did send out the package this morning. I hope you all got that from us.
Yes.
So I'm going to refer you to page 2, which is our standard administrative review. So I'm going to go over, the agenda is to go over to the review. Brian will take over for a market commentary, go over your performance, and then if there's any questions, we can look at the holdings. And I did include the June 30th accounting We will keep it to under 30 minutes so that we can move you folks along. So the next section there is your account information that we always go over. The account was opened in 2007. It has a growth objective. Again, Brian will review that. Evie, you are still the only authorized signer?
Yes.
Thank you. The commissioners I've listed down there. So if there's any changes on your personal information, if you would just shoot me an email, that would be great, and I will update it. The next section is the transaction summary, and I've included the last 3 fiscal years. I did not update for fiscal year to date. I have not gotten that report done quite yet. So you can see the earnings with the interest and dividends, realized gains or losses, and the fees are all reflected there for each of those fiscal years. And then your fees, I've showed how they're calculated there at the bottom, and I'll just go right to the very end. Based on the 9/30 market value, your annual fee equates to 33 basis points. That is our management fee and does not include any broker or mutual fund fees. Any questions on that?
Nope.
Nope.
All right, I'm going to turn it over to Brian. Thank you.
Mm-hmm.
Thank you, Barbara. And given that Joe laid out quite well how painful these can be as fun in the later hour for everyone, and you've got a lot to cover. Before I go in on any kind of prepared remarks, are there items, since we haven't met in a little while, and certainly a lot has gone on since then, that anyone wants to address ahead of time or have me address in these comments? Because I want to make sure I'm conscious of your time and your thoughts.
Joe, I think you had something.
Well, I have something that I want to discuss at the end of the meeting, not at the because it's a request I have for them for the future.
Okay.
I have one thing which I could ask later as it comes up, but I know I think you had a graph in there about the top stocks. I'm trying to remember. I see so many investment things these days. I'm trying to remember what you put in exactly. Hang on one second.
The top 5% of the top 5
Okay.
largest 5 of the S&P.
Yes, thank you. So anyway, I know that's an issue. I know your performance doesn't look great relative to the composite benchmark, probably for that reason. So I'm assuming you'll address that, but also as part of addressing that, I'd like to hear or get a reminder on how you weight the securities. I know you equal weight the sectors or roughly equal weight, but can you also remind us how you weight the stocks within the sectors?
Sure, thank you. Yeah, so I'll go into that first. Yeah, we are more equal weight, and we try to rebalance. We do try to acknowledge that, and obviously the S&P switched it, so technology was shaved off a little. They put it in communications, they put some in, and so they created that new sector. So by doing that, we wanted to acknowledge it and make sure that we have correct exposures there. And then for the individual holdings, essentially what we do is you've got we want to weight them essentially by whether whether it's a 1, 2, or a 3. And so you have essentially 10% in that sector. And in reality, you'd want to have about 4 names in each one of those sectors, but they're not 2.5% each. So essentially your larger ones are getting, you're going to have one that's going to be 3.5. Then you're going to have probably 2 twos usually at 2.5%. And so that fourth one for each sector essentially ends up being a little bit smaller. So that's overall what we want to do.
Is that a function? Is that a function of their size or their attractiveness to you?
That's the attractiveness. And then what would happen though is if it's the largest stock, as far as if you look at the so for 4 larger ones, or I should say, depending on size, you don't want to necessarily overweight it too much. There are situations where it would take up too much of the position. At that point, we could adjust. Or there are times where we have 2 ones as a tie, And so, you know, I guess that's at certain times where I guess we call us playing chicken. Can't decide on 1-1, so that skews the percentages a little bit. But overall, we weight the one more, and so therefore, by default, the third one gets less conviction. A good question, because we talk so much about the sectors that sometimes we forget about, you know, how the securities are. And so I will address it, that to the performance. The first one, and so you can wave your hands at any point. I'll try to, you know, speak a little bit with pauses, so people can jump in. But just start waving, I'll stop, because sometimes I'll speak like I'm, you know, just trying to suck up all the oxygen I can and keep going. So just give me a nod as we go through the, you know, the first slides. When we look at the economy and where the stock market is, you know, obviously moving, you know, day to day, et cetera, and month to month, it's generally back to where we started the year over that, you know, in general, but, you know, day to day it moves. But when people say, all right, you've got the stock market back to where we started the year, yet I walk down Main Street and there's restaurants closed. I don't see hardly anyone coming in and out of hotels. No one's flying. All these items explain to me how the stock market is where it is, given what we're seeing in the economy. And there are two sides, you know, to where you see it. One is kind of in Main Street, and the other part is if you happen to be sort of building Main Street, I will. So the biggest portion is essentially that. I walk down the street, I see everything hurting, what's going on. Where we go here, and so there's going to be two slides. The first slide on the left-hand side, if you think of, you know, the S&P stock market and why does it get to stay up, or how does it stay at this level? I guess I'd say I'm say proud, but I've enjoyed I'm sorry, I'm wrestling with the term here, but happy to see that in the investment community overall hasn't just pressed down or pressed the sell button on all stocks, given that the economy's, you know, certainly on its heels a little bit. No, I would say normally when things are shaking a little bit, they say, okay, earnings are down, the stock market will go down. In this context, or in this year, the market participants have said, well, yes, earnings are down, and that's what's in front of us right now. But let's remember that earnings are really the prices are the present value of future earnings. So when we look at this chart on that page on the left-hand side, on the right side of the left chart, are those three blue bars.
Brian, what page are you on?
Oh, I'm sorry, on page 3. Page
three.
3 of the, thank you very much. Page 3 of the chart book, or the package. So there's a chart on the 3, and then there's 3 columns on the right-hand side of that first chart. And you can see that the first blue chart is lower, much lower, and that's the earnings that we're looking at right now, are the expected earnings. So we're trading at S&P right now, or the end of the last month was trading at about 21.5 times. So now more towards 20, high 20s or 21, but 21.5 as of the month end. The 25-year average has been more like 16.5. So certainly the price to earnings, or what goes into the lack of the higher price due to the lack of earnings, has it inflated. When you look at the next year and the years after, what we've got is saying, all right, there's with the expected earnings. If we don't achieve these, then the stock market should decline, because the prices will be too high for the earnings that they're achieving. So a lot weighs on those, and that's kind of saying, you know, the thought there is that the stock market, or the backbone of it, will be strong, and will you know, the infusions will work for the public. What the Fed has done to keep the markets open and companies strong through this should work, and then companies will be back. And if it happens, if companies do come back and their earnings do, you see in that chart that it will make sense, and then that price to earnings will fall more in the historic range, and it will make sense. So that's the key component. It's not just being held up with hope, but it's hope on the actual earnings, or the expected earnings, should the economy keep moving. On the next slide, this is the Main Street slide. We call it the social distancing. But essentially, if you go down Main Street and you look, and it's really that service and tourism sectors, it's hotels, transportation, bars, entertainment, all the things that we really can't do what we do in a much constrained environment. And those are 19% of GDP. So it's impactful to the GDP on a revenue basis. And then below that, if I go continue counterclockwise, that's the employment. So that's what we're seeing. Those are the people we're seeing out of work. So many of these, think of the cruise line industry, think of restaurants, and that's, the bars, all the people we've seen out. And this is where kind of the humanity part of it disconnects a little with the economy, because there's so many, the payroll is so large for it. Yet when you go to the right-hand side, the actual operating earnings to the S&P is only 7%. So it's about a fifth of the, kind of the percent of GDP. It's, a fifth of the jobs. So we will be looking, or those people will be looking to the government to continue to infuse money there to make sure that there's unemployment benefits. But even if those are working at half capacity, it's really up to that kind of the rest of the sectors or the supply chains to get all our goods and services here that will keep us afloat. They'll keep the stock market afloat. But there is a little bit of a disconnect there between how much, essentially, if you think of it, they're the lower margin businesses, if you will, for the economy. So to the other side of that, and I should probably create a slide for it, because we've noticed if you are in the trades, or I don't know if anyone's been doing any remodeling or anything like that during the COVID experience, you'll find that it's hard to get labor, it's hard to get projects done, it's hard to get them done on time, and so materials are more expensive. So there is real inflation there. It's very full, and it's continuous work for those people. So when you follow those supply chains and you follow that kind of work, a lot of them are saying, hey, we're at full capacity and then some. So that's the part that everyone's not seeing. To the majority of the public that go out and see Main Street, this slide is saying, hey, the economy's hurting. Well, how can the stock market be up? There is a whole side underneath that. So when we go into the winter months, or as we start getting spikes here, a key component is that the supply chains and like kind of the shipping lanes, et cetera, if you will, remain open and strong. Because if those things go similarly to how they did in March and April, then this is how this trails off. So that's the economy ones. Here's to what Hayden was pointing out. And this has been an interesting phenomena. The top 1% of the S&P, or essentially really just 5 companies, are 22%, and varies day to day, but 22% of the stock market, and the top 10 are 29. Very big percentages as compared to where they've been over the last decades, and really since the large conglomerate pieces. And if you think of, the next page is their earnings, but this one on page 6, and I apologize. When I click my slide, I forget that everyone's isn't moving. So I apologize. I'm on page 6 right now. I'm not controlling the Zoom. On page 6 is the market concentration. So I put that 22% market cap there, and then put their earnings. So the earnings are up about 15% for these companies. Whereas their market cap is up about 22%. Essentially, what we're seeing here is this is kind of a momentum trade. People are flocking to these stocks, saying, I don't want to miss out on what's going on, and let's pile in. So what that does do is create a little disparity between what they're actually earning and what is, I dare say, froth in those names. So there's been more people really moving towards them. And so with that, essentially, and I'll go to the next page for me, my closing marks on page 7 there. This is pretty interesting when you think of the S&P 500 through September. Those top 5 that I spoke of on the left-hand side, up about 42%. The other 495 are actually in negative territory. So if you have a balanced portfolio across all the sectors and involved in all those sectors, you had, those ones are down actually negative. And so when you compare those along with the other sectors, you get the 5.57 that it was up through 3 quarters. So when you see this, you can, it's been great for those companies. And there's several other names you could really point to that have run with it. But when you're talking about things coming back into place, and Hayden pointed out very appropriately that we've trailed on a relative basis due to not having an overweight to these stocks. We do have we have Microsoft in there and Google and Facebook in them. They're not the highest earners, and the other ones, we tend not to buy names that fundamentally that look like they're a little expensive. And if you think of Amazon and their earnings have been strong, there's two items with Amazon. One is the fact that it's still a server profit company. All the packages that come to us aren't pushing the envelope on their profitability. It's really the whole kind of server business. And the other portion is that, they're with their price to earnings, or would you say that their premium to the marketplace, they could still have double the premium from the market, and the stock could be down dramatically because of that. So it wouldn't take difficult times or any kind of market dislocation or debacle to have these companies come a little bit more in line with the rest of the market. We're not saying, hey, we're going to catch up because things are going to go haywire. It's really just, and there's been articles written about just even if the Fed stops some of its quantitative easing that it's been doing, will that impact some of these technology companies and bring them back into line? There's a lot of ways it can happen. We're not cheering for it, other than the fact we're prepared for the portfolio to perform quite well should these things roll off. And the other part too that hurt us, it's been a double whammy. It's been the concentration level, and then also on energy as well. We have energy in the portfolio by higher than the index. And when you have low energy prices to begin with, and then you have the Saudis and Russians getting a price war in the middle of a pandemic when no one's using your product, wasn't the brightest thing to do. And energy prices dropped even more precipitously. So the energy has been on its heels. Is it in secular decline? Possibly. Or you should say yes, because the world's trying to get rid of them, but it's still going to take some time for, I like the idea of everyone having an electric car, but if, when the economy stalls, if we still have to cut $600 checks for people to get by, I think we're still further away from everyone having an electric car than some think. But certainly this is, the market concentration has been a big portion.
Ryan,
and we've talked about this. Oh yeah, thank you.
People understand, let me put it that way, that you can't look at the economy and the stock market. They're two separate individuals, right? They're two separate creatures. So in talking about the earnings, this looks wonderful when you look at the earnings that are up. And I don't understand it, I guess. And I know you went through an explanation of why it's happening, but I just don't understand why people are out of work. And like you say, storefronts are empty. People are losing their homes. They're losing their apartments. And yet the market is doing so well. Why?
Yeah, and it's a great question. It's a good question. One that's why I put the charts here to really, some people marvel at, but just to reiterate, all the things that are eye front, if you will, or right in front of us, the restaurants, the storefronts, etc. There's a lot of people, and that puts a lot of people out of work. However, the government and both state and federal level have put money in those people's hands in the form of unemployment. We've seen more volatility most recently as they're waiting for the next round, because that's important for all those people that are out of work to be able to continue to get a paycheck. So if that happens, they'll be in good stead. And that's what happened in the beginning. That's why we saw that huge rush back. Because and just to step back a little bit, the market went down dramatically, and should have. We closed. And then when it was coming back, it was because the Fed, two things happened. First, the Fed came in and said, we'll buy, and put the term buy means that market is open. When the Fed says we will be buying something, or we're going to put a program in place, We'll buy government securities. Well, that means the government market is functioning and will issue bonds. So it says government, then it says corporates. It actually started municipals and high yield ETFs. So essentially saying when it's saying I'm going to buy any of these corporate securities, it's saying that you will have the ability to finance yourself and access the markets to stay open. So companies like, I'm thinking of like Marriott and Hilton in the middle of March, when they were 90% closed revenue-wise, came to market, and I think, and I'm going to get the two confused a little bit just because of the time when it happened, but they came looking for about $1 billion. I think they took home about 1.2 billion, so they got more than they were looking for. They got at 5.75. I think they were coming in at 7.5. They thought they were going to, so they got almost 2% cheaper. That was because the Fed came in and said, hey, we're here and we're buying debt. So people, it was about 9 times oversubscribed. So there were 9 buyers for every bond there was. People were just, and that was a company that was essentially not performing, creating revenue at that time. So the Fed said the markets are open, you can access capital. Cruise lines that had no revenue really whatsoever were coming, they were issuing equity at that time to finance their needs. So companies were able to make sure they had capital to survive or the storm. And then the Fed, and then the government came in and said, hey, if you keep your employees, we're going to sit here and we're going to pay everybody money to make sure that they stay, they may not be working, but they're going to have enough money. So that's how that market came back to where it was. Now, since then, the economy's open again, not in the front. We still have restaurant issues, but like if right now, like there is house building going everywhere. There is remodeling going across the country. Everyone's doing projects. The workers are working. You can't, it's hard if you try to call and get someone to do a job for you. It's really hard to get them to call you back anytime. People are building houses. They're saying, I can't even give someone a date. I have no clue when I'll finish it. We can start. We can get people there. We have no idea because everyone's fighting for the same workers, the same material. So the economy we can't see is working well. The economy is an eyesore right now. Does that help?
Yes, thank you very much.
Evie, just a quick anecdote on that point. I was in National Lumber in Newton, and maybe 2 weeks ago, and they are limiting the number of pressure treated boards and 2x4s and whatever per customer. And I've heard that some of the big chains like the Home Depots and the like, they can't even keep basics like 2x4s and plywood in stock.
Wow.
There's just massive demand for it.
Yeah, go out and order a couch right now and see what it can. If you order a couch, your relative's not sitting on it for the holidays, unless it's already in stock. It's going to be a while. It'll come next year. So it's and that's it's frustrating for us, but it's the other side of the economy that's still churning and trying to catch up, if you will. And so one thing that we always talk about, diversification not really working. It's been painful. And so I put that chart in there, and that's page 8. Again, we can see the U.S. stock market on the far left being the highest in all these other asset classes. Since I always beat this drum, I do just want to remind us that we don't want to necessarily, and I think this group really gets the diversification though, that you want to see the page, before you give up on diversification, you look at the page. Oh, I didn't make it in this one, so I apologize. If you do look at the decade before, the S&P 500 from 2000 2009, I can forward up with that slide if you'd like, actually had a negative performance over that decade, where the other sectors were probably averaging about 80%.
I think you're looking at slide 9, Brian.
Yeah. Oh, sorry. Yeah. I apologize. Okay. So I am the only one that doesn't have it up. Okay. Yeah. Sorry. In slide 9. You can see the differential. So you're actually in negative territory in all these other sectors. Really, we use them to get through that time. So I don't know if it's going to work. It's 2020. I don't know if it's going to work as a decade to decade. I certainly wouldn't like it to be that way, only because it makes diversification pretty strange that rolls over that way. But certainly you have a decade where the S&P, people declaring it kind of dead. Remember people saying, "Hey, don't invest in the S&P 500 anymore. It's blasé. And then the next thing you know, it ruled the roost for a full decade. I don't know what's coming at the end of the next one, other than I know everyone in the world in the U.S. just is dying for 2020 to end. Sorry to even use that word. They are wishful that 2020 would end, and we'll see what it brings. And I don't want to try to predict that we're going to have either slide 8 or slide 9 for the next decade, but we want to make sure we're prepared for anything that does come down there. So on the next page is essentially when we get to the portfolio and the allocation of it. We want to remain in compliance, because that's the one item. If you guys hired us to stay focused on our bond stock split, and you came in here and we were either all bond saying that was because it's going to pour out there, or we're all stock because we're feeling really good about it, that's when we would tell you to seek another manager, because we're trying to guess with your money, and we don't want to do that. We want to stick to what we're doing, stick to our knitting, and we believe long term, and it's really shown that the diversification will help, and having more downside protection through the portfolio will help through those times, and then you pick some good stocks and we'll be ahead. So we believe our strategy is good. Through the long term, we think it will actually help to be able to be forceful of it now, and not necessarily turn it on its ear just because we missed the run of Amazon.
I'm the neutral position, if you will, on international is about 20, yet you're above that. And not by a lot, but you're above it. Yep. Generally, since it's been lagging, that would cause it to become underweight unless you rebalance. So 2 parts. When do you rebalance? Or is this kind of a bet that international will do better than the U.S.?
No, we're not making an international bet, though I did see a pretty good slide the other day that makes me, overall wonder if international will do well. I'll describe that in a second. But no, essentially when we rebalance, we don't necessarily take it right back to the weights, because empirically, kind of what it's shown is if you're overweight and you start bringing it back. It's really it shows mathematically that it's probably the best way, instead of taking it all the way back in one shot, because of the momentum factor, so to account for it a little. The reason why some of the stocks are up higher than they have historically been is really just the March. It was our last real full rebalance. So we fully rebalanced at that point. So international has certainly grown. The domestic equity has certainly run from that time period. So right now, as we're looking into the back half of the year and the election, et cetera, we're going to probably be bringing things back into them again, because you want to make sure that same thing as just like in March. You want to make sure that you're rebalanced at the worst of times. And kind of at time zero, or when things aren't moving as much. Yeah, and it's not making a national bet, but I did think it was interesting. And so, sorry about this, Andrew, but I saw just the other day, or I would have put it in this. I saw it yesterday late, or I would have put it in. There's some bubble charts now that show how much of percent of GDP in dollars that each government has put into the market, both in 2008 and in now. We were the leaders in 2008 in quantitative easing, to which the world said, "Oh my goodness, you get too much money there. You're going to squeeze all productivity." Ended up being the best thing for us. That very quantitative easing ran, where Europe didn't really start in full throttle until probably 2012, 14 in earnest. So this time we're actually in the middle of how much money we've put into our economy versus a lot of the others. So I wonder if that'll help some of the European countries actually get ahead. But that's not a bet we're making. That's a slide I just saw yesterday. But it would be nice to see international actually start working again. In the performance, we talked about, you see 1 year and is the, I've got year to date at 149 there. You see the 1 year in the 3 and the 6s, and then when you get in the longer term, the 5 and 7s, the 5 and the 10 year and the 7s, and certainly through time and at the 5s as well. So if everyone's seen the forms of any comments, so obviously the bonds, the one downside of having these strong bond returns is that we got probably several years worth of return in 1 year. And now interest rates are so low, it's going to be a little frustrating when we wait and see what happens from here. If the Fed says, hey, we're going to continue to stay low, we'll see how much, whether we tick around at, the 10-year with 81 basis points today, if that's what our interest rates are going to be, where credit's real tight too, or whether we could be able just trying to get that 1% and 2%, or if interest rates, start climbing up as well, it could be a headwind coming in for the portfolio. But with low rates, we have to understand that we got really strong returns when we probably didn't, we only had 2.240 on the 10-year coming into this. So those were strong. And then on the equities, as I said, they've had positive given everything that it's transpired in the stock market. And now it's kind of a wait and see for the future. Hopefully the pandemic ebbs more than it flows. And obviously, and we need cooler heads to prevail, certainly around the election. Behind that, we always put the, I think we forgot one time, I shouldn't say always, but we put the Morningstar page in there that shows a lot of analytics and deeper numbers for it. So if you had looked at it and have questions, that's great, or I won't dive into all the pieces, but certainly there's a lot there to chew on at any point.
Brian, this is probably a good time for me to ask my question.
Yes.
Next month, the commissioners will get together and we will review our investment policy.
Yep.
Okay. In the last couple of weeks, I've been looking at some major houses and their 10-year annualized forecasts of rate of returns for different asset classes. And to be quite frank with you, all of them are very low for every asset class. I think value equities, for example, are like 3 to 5% annualized for the next 10 years. Growth equities, something like 1 to 3%, recognizing what's happened in the last couple of years. What I would like you to do is review for yourself and for what you're thinking, our investment policy statement and the asset allocation that we have, and come up with any recommendation you might have. And maybe you can send that to us in the next couple of weeks, just by an email, so that we can use that as we deliberate next month on if we are going to make any changes. We may not, and as you know, we haven't made any since 2011 or whatever it was. So, okay.
Yeah, most definitely. Yeah, because it's hard right now, and that's why we're very sure with that. Like the pension and OPEB and even trusts are wrestling with that, because right now when they say long term, I think they're really midterm. Expected returns are quite low, and really the pension and OPEB people should probably be using 50-year expectations, because that's how long their process is, and trust funds essentially to perpetuity. So you can go with longer time frames. So it's the last 70 years are probably better to look at than the next 10.
Yeah, we basically spend 4% of our portfolio every year, so we care about that, and we care the return. So I don't know if any of my fellow commissioners would like to add or make a comment regarding that. I guess not. So, well, thank you for your.
Yeah, no, that's thoughtful to be looking at the allocation now. Where things are, and obviously just kind of put it in its box or perspective.
Okay.
I think we've run over our 30-minute allocation here. So any other questions before we sign off?
Brian, on the Morningstar page, there's a peer group benchmark 2, Needham peer group. Who is that, or what is that?
Yeah, I can get exactly who it is. Essentially the going to, we went to in the Morningstar and said, all right, what are people that are having these general percentage ranges? Because they won't just say, hey, let's grab everybody that's 65% stock, or essentially they bucket them. Mm-hmm. And so it's saying, all right, everyone in that range group around your allocation, let's put those in there. I can get the how many are actually in there.
Are these like municipalities, or are these like?
No, it's essentially taking because it's all Morningstar based. So they're looking at managers from across the country.
So it's mutual funds, probably.
Yeah.
Okay.
I can get more color on that.
Okay.
Any other questions?
Okay. Once again, thank you, Barbara, and thank you, Brian, for your report.
Right. So I have the two takeaways is have Brian review the IPS and let you know about any recommendations, and we will follow up on that peer group on Morningstar. And I think that was it. Did I capture it all?
Yes, I believe you have. Thank you.
Yep. Do you have the copy of the policy, the latest policy, I assume?
Yes, I do. And if I don't, I'll reach out to Abby, but I'm pretty sure that I do, yes.
Okay.
All right. Well, we thank you very much for letting us attend this meeting. And it was nice seeing you all, even though we weren't in person.
Yeah, it is great to see everybody. I'm telling you, we had one earlier, and I was telling those people, I go, it's so great to see people. I shaved off a 2-month beard today because I was so excited that I was going to see a whole bunch of people.
And he looks a little strange to me because I hadn't seen him since he shaved. So
yeah, I grew one when the kids went out of school, and then I grew one when my daughter first went to college. So when they went back to school, and so I said, all right, it's time.
It was nice to see you in your beard.
Yeah, it's funny. It's like the size of my head, though. It's very gray here, and then just colored in the front. At some point, but so it is great to see. It's great to interact like this because we were just talking about on another call that I was on. This is actually better than almost what you can do now, because if you're sitting in front of people, you got to sit with masks. So it's just a bunch of eyes looking at each other like this, which is difficult. And then obviously on the phone, there's no real context. So I know it's difficult for everyone, and you can see them in the spare room. We got the thing going. I just saw in the back. Oh, wait, I got soccer balls going back there. So yeah, and that's what happens with 2 kids at Zooms. They took all the other rooms and sent me to the 3rd room for an office. I actually see Barbara's in the office. I'm usually in the office. I got ousted right now, so I'll be back in next week.
Okay.
All right. Well, thank you again, guys. We will we'll be in touch.
Okie doke.
Bye.
Thank you.
Great to see everybody. Thanks, guys. Thanks for the question.
Bye.
Bye-bye.
Bye.
We've got 2 more things to do. One is I've got to tell you about my report to. I talked with Bill Supple, and I'd like you all to know exactly what he said. If you recall, this is in regard to the Siegel fund that's under question as to how much we should be giving, and the trust says we should give the income of the portfolio. The portfolio now is about $300,000, a little bit more than that. And I asked Bill if he recalls when we received it, because he was there when we did, and I believe it was 2007 or 2011, something like that, when it came in. And he says he remembers sitting with Evie and myself, and it came in terms of securities, actual stocks, instead of a lump sum payment. And the stocks amounted to about $200,000. It actually turns out it was a little bit more than that. And he says he remembers calling up Rockland and telling them to be careful, to keep the securities that they wanted, and that to be careful selling the rest because, and keep the commissions as low as possible. He remembers that. Then I asked him about if he remembers talking to the lawyer about the income. And he said he doesn't remember that. And I reminded him what it said. And he said, and these are sort of almost a quote of his. He said, lawyers always take the easy way out when they write these things, and they use the term income thinking it's a specific thing. He says, but income isn't a specific thing. He says it's dividends and interest, yes, but it also, is it capital gains? And what if there's capital losses? What do? Take the security, the scholarship away? He says, what we did is a standard, and we were consistent throughout. Our standard was 4% of the outstanding balance of the trust will be applied, down to either the nearest 100 or the nearest $1,000. That's precisely what he said. And I have it written down. I wrote it down, actually. consistent with our standards, 4% of the outstanding balance. We applied that. That's what he said. But again, he does not recall talking to the lawyer. I thought we both talked to the lawyer at the time, or we agreed initially when we were there. But so we'll keep that in mind when we see Miss Gooduti. Is it? No, not Gooduti. Galati.
And Galati.
Yeah. And we should do that relatively soon because they have to come out. I think she said they put out the scholarship information like in January.
Yeah, I think so.
Yeah. And the next thing we have to do is find a date for our next meeting.
Before we move off that, so that's Bill's recollection that he's just kind of reinterpreted it to mean, there's all kinds of income and lawyers are just lazy, but is that an acceptable conclusion for us?
Well, we have to decide that, and I'm not suggesting we decide it today, but there is a precedent. I do recall that when that first year of that scholarship was an $8,000 scholarship, which was basically 4% of that $200,000 gift. And we've had and it was 4% throughout, really up until this year. And so there's a precedent there that we also have to keep in mind.
Yeah. So do you want to put it on the agenda to discuss at the next meeting?
Yeah, because I'll pull out all the paperwork that I have, and I do have copies of the minutes that doesn't have much information in it, but I do have a copy of the minutes saying we accepted the scholarship, the trust. So yeah, I'll put it on the meeting for the agenda for the next meeting.
Okay.
Yeah. I mean, I think we all agree that 4% is the right number. The real question is, do we have legal authority to state that, or does the trust suggest something else? And I think that's the issue, right, Dan, with you?
Right. I mean, we can look at it now that we're in a ultra low rate environment and say that maybe they didn't anticipate this kind of environment or whatever, but it still says what it says. So, to just kind of interpret that income can mean appreciation or depreciation seems sort of like just making up rules to suit what you think the rules should be. But, I mean, I don't know what the process is for amending this trust. I mean, who would have the power to do that? Or should we make a recommendation as a commission to whoever has the power to do that they just change the wording slightly? Am I creating a whole lot of lawyer work here, or how would that all work?
Well, you have to, you have to, first, if there are any people still alive that were involved with this trust, you would go back to them and see if they would agree to change the stipulations in the trust. If not, it can be taken to probate. And we've done that with a couple of trust funds, like we had a trust fund for the Dwight School, which no longer exists. So the town's attorney went to probate and had it changed so that it could be used for the Newman School or one of the other schools. But it's a legal process that, yes, you have to go through if there are no survivors or people related to the trust.
Probate sounds expensive.
Yeah.
Well, there's no need to go through a probate if we can get everybody to agree to the
Exactly.
interpretation.
Well, people that would be involved in the trust. Yeah, if you could get them to agree, you would have to go.
Should we have the town's attorney come to the meeting, or you don't think that's necessary?
I thought he retired. Did Dave Tobin retire?
He passed away.
Yeah. Oh.
We do have a new attorney. I've never met him, a young man. I mean, we could, if you want, I can try to invite him.
Evie,
I don't even know his name.
Does anyone else? I can't remember now. I know we looked at it. What the trust said. It just said distribute the income. Is that what it was?
I believe it says income. Yeah.
I mean, Evie, before we decide if we need to invite attorney or whatever to the next meeting, could we maybe could you figure out if the people who we would need to speak with are still available? And have us understand how that, because if it's as simple as, drafting a one-page amendment that someone who's still alive has the power to sign.
That's right.
And avoid probate and get it on the right footing for the future, then let's take that approach. So let's answer that question and then deal with what comes next.
Yeah, I think that basically probably the only person left is the attorney, if he is still alive. Because this was a trust, if I recall correctly, a certain person died, and that's why the trust was available.
The third person died, I think, wasn't it? The third person? Was there a husband and wife, and then it went into trust for someone, and that person died?
Yeah, something like that. Okay, I do have a calendar in front of me.
Actually, sorry, Joe, before we get to that, but there was one other operational question that came up via email since the last meeting, and that was this request for someone returned a check to you, Evie, and asked that it be divvied up into 4 checks. Remember that?
I thought that was all resolved.
What? I'm sorry.
Someone, a recipient of one of the scholarships, had returned the check to you, asking that it be reissued as 4 checks.
I guess it was resolved when we said that we couldn't split it, because I never heard another word.
Oh, I thought they had actually returned the physical check to you, no?
Yes, they did. You're right. They returned the check to me, and then the school department initiated a payment to them of 1/4 of the award, which I stopped. And I believe they then produced a check for the full amount of the scholarship. But I'll confirm that. I never heard any more about it. So thank you for reminding me, because we'll track it down.
But my understanding was they got the original check and then sent the original check back to you?
They did.
Okay. So then you canceled the one they were sent back to you and then just reissued it essentially in full.
I'm sorry. We received the check back. They had written void on it, so we couldn't, send it back.
And then you reissued it to them in the same amount.
Right.
Okay, that's fine by me.
Yeah, no, I'll just confirm that.
Okay. So the month of November, the 26th is Thanksgiving, which is the 3rd Thursday. The 3rd Wednesday, which is the 4th Thursday. The 3rd Wednesday is the 18th. I don't know if that has, if that's an available time for all of you folks, but that seems like the most likely time for us to have our next meeting.
Works for me.
Works for me too.
So Evie, it's up to you.
We have, did everyone receive the vouchers that I sent earlier today?
Yeah, actually, I meant to ask about that. I forget what we're doing now that we're doing Zoom meetings. Do you want us to still reply via email so you have a record of it, or?
I do. You could just reply like, I approve all. And what I do is I put together a list with the copy of your emails to the accountant so that they know that they were approved. Okay. So yeah, if you could just either respond to what I sent, or
there's no point in discussing them at this meeting, right?
Well, you should vote. You should vote to approve them, so that something is official.
And then still reply via email.
Yeah.
Okay.
Evie, I don't happen to have that email from you. I did not receive it, or if I received it, I killed it.
You didn't receive it?
Dan, did you receive it?
I did. Maybe it made its way into a spam folder of yours, Joe.
I can send them again.
Yeah.
I wouldn't know how to look for one in a spam folder.
Evie, would the town ever consider DocuSign or something equivalent to that?
We do have DocuSign, but I don't have it. The town has it, but I don't have it.
Okay.
All right. So we'll just reply via email.
Yeah.
Right?
Yeah.
Okay. unless, I mean, if you want, I guess, I don't know, Dan, did you look at them yet or no?
I did. I was fine with them. Evie, I think you may have included
There's an
a
extra
copy of
page.
an email on an unrelated topic in there. There
I
was
sent you
one,
something.
yeah, there was
The last,
one,
the last
there's
file.
the invoice for the revitalization trust included a copy of an email that you sent about the revenue software decommissioning project that's going
sorry.
on. I'm glad to see that you're looking out for my tax dollars. I appreciate that. But I don't think it was related to our project here.
I probably meant to send that to someone else.
Well, you didn't send us the email, but
No,
you
it
included a
wasn't.
PDF of the email along with this invoice.
Yeah, it wasn't a separate attachment. I think it just got stuck to the bottom of the NRT invoice.
Okay.
Okay.
It's fine.
Well, in any
All right.
event, Evie, I didn't get it. So if you
I'll
send them all
send it
back,
to you, Joe, without the extra attachment.
that's all right.
But if you need a vote, I can propose I vote to approve. Dan can second it.
Yeah.
Okay.
Okay.
I vote
Dan?
to approve.
I second Hayden's vote. This is Dan
All
Burns,
those-
second his vote.
All those in favor, please respond when I call your name. Hayden,
Yes, I vote in favor.
Dan,
I also vote in favor.
and I, Joseph, also vote in favor.
Okay.
So, and we'll send it back to you.
Okay.
All right. So
We'll have-
did we decide on the 18th? Is that set?
Evie was the only one who did not respond.
Oh, I'm fine.
Okay.
Okay, so it's reset then. So I will entertain a motion to adjourn.
I make a motion to adjourn. Hayden does.
Dan Burns, I second that motion.
All in favor, say aye. The ayes have it.
Aye.
Meeting is adjourned.
All right. Everybody,
you.
Bye.
and everybody.
Bye-bye, everyone. Thank you.
Thank you.
Bye.
Thank you. Everybody take care.
Yep, you too.
Recording is off.